Happy Friday, folks. Jeremy Tyler coming to you from the Hammons Tower here on August 2nd. Been a lot of market volatility this week, statistically the most volatility, meaning up and down moves that we have ever had. And I'm sure that many of you pay attention to your accounts, and hopefully you like the results that we have at least this week. We've had some challenges with investing this year for several different reasons, but one of them is really tied to the yield curve and how the Feds and the current incumbents are really desperate to convince us that this is a good economic environment that we're in. And I think you and I both know that that's just not true. I really, short of saying something bad, it's really hard to believe anything you hear right now. Everything boils down to this yield curve right now. I'm on investing.com if you'd ever like to look at this. They show you what you're getting interest rate wise on 1 month paper all the way down to 30-year paper. We have what they call an inverted yield curve right now. An inverted yield curve is simply referring to the 10-year rate versus the 2-year. Now it's barely inverted now, meaning you get more interest, 3.939 at this moment on the 2-year versus 3.826 on a 10-year. You should typically get less interest on shorter money than longer money. To represent that in a graphical manner, this is a 10-2 chart. Basically, it's the 10 minus the 2-year treasury. And if we look at this over time, you'll see it's a real good precursor to when recessions start. You're going to hear me say the dreaded word recession. The Feds, the media is not going to talk about this, but folks, there is not a good piece of economic data out there. There hasn't been really since October of last year when they started pumping the markets with your dollars. So here's a 10-2 basically coming out of a slight type of inversion here, but we want to go to more of a max type of chart. And if you look, whenever the purple is on the bottom side, that's when we are inverted. As soon as it comes up above, you'll see halfway through a recession or so, the gray bars represent a recession. The trend here, when we're below and we come above, a gray bar shows up. We have been below longer than we have any other time in history, any other time. And they're continuing to tell us that this is a good environment. I think the story ended this week. I'll show you a couple of reasons why in the written email below. I just wanted to show you some charts here so you'll see maybe more of a little technical side of what goes on behind the scenes. This has been uninverting at a very quick pace recently, today specifically. So if you look here, we are now just 17 basis points, they would call it, from hitting the break-even line. And that's just simply, again, taking this 10-year number minus the 2, or the 2 minus the 10. And that difference right there is going to be this 17 basis points, 0.17%. That uninverts, that's a challenge. So let's talk about what are the Feds doing to keep this from uninverting? Well, they just issued another set of Treasury buyback operations, $30 billion worth. So what they're doing is they're issuing really, really short paper. 1 to 2 months is common, but you'll see they've got some longer terms in here. Here's the amount that they're issuing, and they're adding to our national debt at a rate we have never seen, basically running the whole country. It's amazing. So this here is an effort to try to piecemeal things together till when? The election. Excuse me. So the liquidity support, what they're saying, this is money that they're using to keep liquidity available in the stock markets or to keep it held up. Now they're having challenges because none of the economic points are coming across as positive. So it's going to be real hard for them to hold it up from here. I don't think they will be able to. Let's look at a couple of charts so you can see where we're at. This here is the DIA, or Dow Jones Industrial Average. And if we look at this chart, every candle represents a day. And really what you're looking at is we had a trend going up here for quite some time on a daily. And then we are outside of that trend. And then this orange line represents a very important level. We touched the 50-day moving average and then went back above it today. I wouldn't be surprised if we get below there fairly soon, and we'll be touching this type of level in the next week or two. The tech stocks are the ones that are really getting beat up lately, and deservedly so. Frankly, they're way overbought. overly expensive, and it's just been the most manipulated area of the market, and we are shorting them still. So here's your trend line again, just a blue bar. You'll notice we had a pivot point where it touches, and then all of a sudden we're outside of that. Whenever you break a trend, that's not good. There will be a new trend to develop, and it won't be going up. It'll be going down. S&P 500, same thing. You've got your support lines, touch, get close, and then break outside of that trend. There will be some bounces. It's not going to be all down, but there really is no particular reason for the market to go up, as you'll see in the employment data that I've listed below. Unemployment now has ticked up to a level that we've broken what they call a SOM rule, which is another recessionary indicator. We're in a recession, folks. We are. It just has not been declared. Germany has printed 6 quarters of negative GDP, and they have not said the word recession. Japan's stock market fell 6% last night. Briefly talked about recession. There's a lot of politics involved in all this stuff right now, and I don't think it's for the better. I mean, gosh, we've got men boxing women in the Olympics, and let's not even talk about the crap show that was the opening of the Olympics. So I don't know. Anyways, here is a very important position for us. SOXX represents the semiconductor short that we have, meaning we're positioned against them, and we have really been benefiting the last couple of weeks. SOXX is holding these stocks: Broadcom, Nvidia, AMD, all of the high flyers. You remember back in the day we talked about this being overpriced. Well, it's really started to come back to reality. So we had supports here, and then you put on a short at the top because it appears it's going down. You break the 20-day moving average, which is this line. So we broke there. You break the 50 here. Now we're outside of this channel where it was support a couple of times, right? We are outside of that channel and now sitting on the 200-day moving average. And if we look at that real time, the 200-day moving average is right here, these purple dots, and that value is 208.76 on this right hand menu. The price is 207.34. It's underneath there, so we gapped, they call it, because you have a gap between yesterday's price and this price all the way down below the 200. It doesn't really appear that it's going to be able to break back through that. If it doesn't, we continue to be off to the races and benefiting from the fall of these positions. We remain short. It's the same story that we've had before. There's really not many positives out here. So we're going to keep going the way we are. I've been selling some of our winners and putting them into bonds because bonds benefit as rates go down. And if you're not familiar, bonds falling, 3, 4, 5, 6% today is a lot. There's a lot of moves going on. We are benefiting from them. Apologize for the volatility. It's really not something that's that enjoyable to work through, but I like it. As long as you can hang tight, I feel it will come out all right on the end. We're going to have our quarterly reviews in middle September to November 1, somewhere in that neighborhood. So we'll be talking to all of you soon, and we appreciate you greatly. Have a good day.